Webinar 7. In trying to keep these webinars short and simple, this one's probably going to be the shortest and most simple of all because it's only one pattern and there is no bullish or bearish version of it. It's just one simple pattern, and it's also nothing that you haven't seen or done before. So this is going to be pretty easy. What you're looking at here is called a flat base. See that along the bottom? Or also known as a fry pan bottom. Some people will call it that. Fry pan because it looks like a fry pan with a handle. Or else it also can have the name rectangle bottom because, as you know, this is also a sideways channel, and in trading, traders will call channels rectangles since they are a rectangular shape. Rectangular shape. So the pattern itself is pretty easy, like I said. For a flat base, basically what it is a downtrend into a year low, and then that forms horizontal price action for some time. After the sideways action, price should then move up and the rise should be a little bit choppier than the fall. So the rise is not usually a straight line. All right, so we can call it a sideways channel, we can call it a flat base, we can call it a sideways rectangle, we can call it a fry pan bottom. It doesn't matter. Some of those patterns are all considered separate entities and taught individually. The fry pan bottom will be taught as a candlestick pattern as well, so just keep that in mind, that this is not really technically a fry pan bottom. It's just a term that I'm using. I'm combining them all into one lesson rather than being specific with each individual pattern, because basically in my mind they're all basically the same and act basically the same. Alright, so you want your flat base to be longer than 65 days for best performance. Generally you'll find these over years, and those actually perform the best because, as we've learned in past webinars, the longer the consolidation, the bigger the breakout. So this is over, 1, 2, 3 years. So that's usually what you want to look for and what you want to find. And then when price closes above your top line is when you'll enter. So just like a breakout of a channel, here's your break, Here's your confirm. Enter a penny above your confirm, and then you're in. And then the measure move rule could be the same. You take the low and the high. So my high is 32, my low is 17. So we'll just call this a measure move of 15. And then you add 15 to the top, and 32 plus 15 puts you up at 47, which is exactly where this went to. Okay? So this worked out pretty great. And also the reason why it's flat base is because it's at the bottom of the years. It's not in the middle. It's not at the top. This is at the bottom. So that's what you want to look for. You want to look for the pattern at the bottom. And you don't want rounding. Okay? You want it to be flat. It can bounce between two prices, as mine does, but you want the main concept to be a sideways flat pattern. All right. The measure rule like I said, is the same, but with this pattern, sloppiness doesn't matter, because some of this price action here might generally be down here instead, making it a real straight bottom. Okay? So in this case, don't worry about the fluctuations as much. I'm not so concerned about that. Just know where the basic high is and where the basic low is so you can do your math. But they generally have a prior downtrend over 65 days long, usually years, flat price action like a sideways channel, and then you'll usually get a break upwards, so it's a reversal. %85 of these will meet their price target on the break up, as this one did. So that's a very good percentage. And if it breaks downwards, only 50% meet the downwards price target. The breakout is generally a 50-50, up or down, but I would say that it would have more of a upwards breakout slant to that percentage myself. I would take liberty in saying that, since it's a huge downward, big consolidation at the bottom, and then you probably will get a reversal. But it can go either way. Don't be surprised. And that's really it. There's not really much more to talk about or show you. Like I said, I just wanted to keep this one simple because it really is simple. It's just a it's just a simple concept that I just want to point out. It is a pattern, but there's really not much to it. You know, you just find your top, find your bottom, the flat base at the bottom of the ears, downtrend leading in, and when you get to breakout, you just project your height from the bottom of the channel to the top, and that's pretty much it. And like I said, since these are at the low of the ears, you can generally expect a reversal. But make sure that this bottom is flat, and I'm not concerned about the beautiful look of the channel. It will bounce up and down, and I don't care how low it is. I prefer it to be lower than higher. You don't want it to go too high as far as your price action. Okay, you don't want that. You want as low and thin as possible, preferably like that. Make it a real nice tight consolidation, and make it look more like a line than a channel. That's what you're looking for. Real tight line. All right? And that's called a flat base, or a rectangle bottom, or a fry pan bottom. And make sure that the only real rule is that it's over 65 days, and generally the breakout can be in either direction. I think that most of them will break upwards, and if they do break upwards, 85% of them will meet the target, which this one did. If it breaks downwards, we're not going to chart the downwards because we always want to chart upwards as much as possible. But if it does break downwards, just for your own knowledge, only 50% meet the target. And that's it. I wanted to throw out there a quick webinar with a quick pattern, you know, to kind of give you another gift. Like I said, I know that, you know, you've been working so hard on all these webinars, and sometimes they get long, and there's a lot of confusion, and there's a lot of work, and a lot of searching and all this sort of stuff. You should be able to find this pattern pretty easy, and good luck.